Hey everyone, and welcome back to the channel. Today, we're diving into a topic that can seem intimidating, but is absolutely crucial for building long-term wealth investing. If you've ever thought, investing is too complicated for me, or I don't have enough money to start, then this video is for you. We're going to break it all down, step by step, into simple, easy-to-understand concepts. By the end of this video, you'll have the confidence and knowledge to start your own investing journey. So grab a notebook and let's get started on demystifying the world of finance and unlocking your financial potential. So how does investing actually work? At its core, investing is the process of using your money to buy assets that you believe will increase in value over time. Think of it like planting a money tree. You put a seed, your initial investment, into the ground, with time, sunlight, and water, which represent market growth and your patience. That seed grows into a tree that produces fruit or returns. These assets could be shares of a company, also known as stocks, or loans to a government or corporation, called bonds. The goal is for the value of these assets to grow, so that when you eventually sell them, you make a profit. It's not about getting rich overnight, it's about making your money work for you, so it grows steadily while you're busy living your life. This fundamental principle is what turns small, regular contributions into significant wealth down the road. Now, let's talk about the secret sauce of investing, the one thing that truly supercharges your wealth-building journey: compound growth. Albert Einstein supposedly called it the eighth wonder of the world, and for good reason. Compounding is simply the process of earning returns on your returns. Here's how it works. You invest some money, and it earns a profit. The next year, you earn a profit not just on your original investment, but also on the profit you made the year before. It's like a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow, getting bigger and bigger at an ever-increasing rate. The longer you let your investments compound, the more powerful this effect becomes. This is why starting to invest as early as possible, even with small amounts, is so incredibly powerful. Time is your greatest ally in the investing world. So, what can you actually invest in? There are many options, but let's focus on the main types you'll encounter as a beginner. First, we have stocks, also known as equities. When you buy a stock, you're buying a small piece of ownership in a company, like Apple or Amazon. If the company does well and its value increases, the value of your stock goes up. Next are bonds. When you buy a bond, you're essentially lending money to a government or a corporation. In return, they promise to pay you back the full amount on a specific date, plus regular interest payments along the way. Bonds are generally considered less risky than stocks. Then there are mutual funds and exchange-traded funds, or ETFs. These are fantastic for beginners. They are collections of many different stocks or bonds bundled together into a single investment. This instantly gives you diversification, which is something we'll talk about next. You've probably heard the saying, "Don't put all your eggs in one basket." This is the core principle of diversification, and it's one of the most important rules in investing. Imagine if you invested all your money into a single company's stock. If that company performs poorly or even goes out of business, you could lose everything. But what if you spread your money across 20, 50, or even hundreds of different companies in various industries and countries? If one company doesn't do well, its poor performance is balanced out by the others that are doing great. This is what diversification does. It helps to reduce your risk. By holding a mix of different assets, like stocks, bonds, and maybe even real estate, you're not overly exposed to the fate of any single investment. It's a strategy to smooth out the inevitable ups and downs of the market and protect your portfolio from major losses. Now, let's tackle the concept of risk versus reward. In investing, these two things are always linked. Generally, investments that have the potential for higher returns also come with higher risk. Stocks, for example, can offer significant growth, but their values can also drop sharply in the short term. This is high risk, high potential reward. On the other hand, government bonds are much safer and more stable, but they typically offer lower returns. This is low risk, low potential reward. The key is to find a balance that you are comfortable with, which is known as your risk tolerance. How would you feel if your investments dropped by 20% in a month? Would you panic and sell? Or would you stay calm, knowing it's a long-term game? Understanding your personal risk tolerance is crucial because it helps you choose the right mix of investments that will let you sleep at night while still working towards your financial goals. All right, you've learned the key concepts. Now, let's put it all together into a practical, step-by-step guide for getting started. First, define your financial goals. Are you saving for retirement in 30 years, a house down payment in 5 years, or something else? Your timeline will heavily influence your strategy. Second, determine your risk tolerance. Be honest with yourself about how much volatility you can handle. Third, open an investment account. For most beginners, a brokerage account or a retirement account like a Roth IRA is a great place to start. Many online platforms make this process incredibly simple. Fourth, choose your investments. Remember diversification. As a beginner, low-cost index funds or ETFs are often recommended. They give you broad market exposure instantly without you having to pick individual stocks. An S&P 500 index fund, for instance, lets you invest in the 500 largest U.S. companies all at once. Finally, and most importantly, automate your contributions and be consistent. Set up a recurring transfer from your bank account every month, even if it's just a small amount. The habit of consistent investing is more important than the amount you start with. Then, be patient. Let compound growth do its magic over the long term. And that's it. You now have a solid foundation in the basics of investing. We've covered how it works, the magic of compounding, the main types of investments, the importance of diversification, the balance of risk and reward, and a clear, step-by-step plan to get you started. Remember, the goal isn't to become a stock-picking genius overnight. The goal is to build simple, sustainable habits that will grow your wealth over time. The journey of 1,000 miles begins with a single step, and you've just taken a huge one by educating yourself today. The best time to start investing was yesterday. The second best time is right now. Thank you so much for watching. I hope you found this guide helpful and feel more confident about starting your investment journey. If you got value from this video, please give it a thumbs up. It really helps the channel. And don't forget to subscribe and hit that notification bell so you don't miss our future videos on personal finance and investing. If you have any questions, drop them in the comments below. I'll do my best to answer them. Until next time, happy investing.